China and its strategic move to challenge the dominance of the US dollar. No SWIFT, no USD. China is reshaping the way the world pays. Is the global position of the US dollar under threat? By the first quarter of 2025, China had processed over 18 trillion yuan, approximately 250 billion USD, in cross-border transactions using the digital Yuan eCNY. This system is directly integrated with CIPS, which now connects more than 1,400 financial institutions across 110 countries, enabling fast, low-cost transactions without relying on SWIFT. The eCNY enables near-instant and virtually cost-free transactions. This advancement helps businesses reduce operational costs and shortens payment times. While individuals benefit from more convenient international money transfers for migrant workers in particular, the ability to send money home faster and at lower fees can make a tangible difference. Less money lost to fees each month and near-instant access to funds. This, in turn, can improve household spending and reduce reliance on traditional financial services. Moreover, those without a bank account can still participate in the financial system through the eCNY wallet, broadening financial access and inclusion. By the end of 2024, China had signed more than 40 bilateral currency swap agreements, with a total value of 586 billion USD. These agreements not only strengthen financial cooperation, but also improve access to financial services in countries with limited banking infrastructure, reducing reliance on physical cash and exposure to USD exchange rate. Volatility. The share of China's cross-border transactions conducted in yuan rose from 40% in 2021 to 53% in 2024. Within the ASEAN bloc alone, transaction value reached 5.8 trillion yuan in 2024, an increase of 120% compared to 3 years prior. For businesses, this shift lowers currency conversion costs and helps stabilize exchange rates for individuals. It contributes to curbing imported inflation and helps keep the prices of essential goods more stable. The digital Yuan eCNY is also being used in Belt and Road Initiative projects, such as the Gwadar port in Pakistan and the railway in Laos, where it enables direct payments and capital oversight through smart contracts. Local workers receive wages via eCNY, allowing for faster, transparent, and intermediary-free payments, supporting higher earnings and reducing leakage. Currently, 13 BRI countries are piloting the use of eCNY. The rollout of the digital Yuan, eCNY, is playing a growing role in reshaping the global financial system, especially as Beijing moves to expand the use of the yuan in international trade. Following the United States' decision in April 2025 to impose a 145% tariff on Chinese goods. As of March 2025, the cross-border payment system based on eCNY had been connected with 10 ASEAN countries and 6 Middle Eastern nations. This network enables faster transactions, lower costs, and eliminates the need to route payments through SWIFT. According to the Bank for International Settlements, BIS, the use of central bank digital currencies such as the eCNY could reduce international transaction costs by 5 to 7% compared to traditional banking systems. The BIS also notes that access to financial services could increase by 4 to 6% in developing countries with effective digital payment systems. This shift not only helps partner countries reduce their dependency on the US dollar, but also supports more stable commodity prices, thanks to lower transaction costs and reduced exchange rate volatility. For everyday citizens, particularly in developing nations, faster and cheaper access to financial services can lead to improved daily living conditions, lower costs, and expanded business opportunities. The U.S. disrupts supply chains and raises risk of global recession. The United States is increasing pressure on countries to choose sides between Washington and Beijing, particularly in the high-tech sector. Could the U.S.-China tech confrontation pull the entire world into a new economic downturn? The United States is advancing a strategy aimed at distancing China from the global supply chain, particularly in the high-tech sector. The Washington administration has expanded export control measures, not only applying them to American companies, but also requiring foreign firms to choose between cooperating exclusively with the U.S. or with China. According to Bloomberg, the U.S. has imposed an additional 20% tariff on a wide range of Chinese products and has further extended its chip export restrictions. The restrictions on chip exports to China have also resulted in significant losses for American businesses and their global partners. According to Bloomberg, October 2024, NVIDIA is expected to lose $5.5 billion in revenue due to its inability to sell advanced AI chips to China, an amount equivalent to roughly 20% of its projected 2025 revenue. ASML, Netherlands, the world's leading manufacturer of chip printing machines, has warned that its revenue from the Chinese market could decline from nearly 50% to just 20% by 2025. Companies such as Tokyo Electron, Japan, and Samsung, South Korea, face similar risks. Disruptions in the global chip supply chain are likely to drive up the prices of consumer technology products, such as smartphones, laptops, and electric vehicles, due to increased production costs. Furthermore, if companies are forced to reduce investment and cut jobs to offset losses, the risk of rising unemployment in the tech sector will grow. The impact of the U.S.-China competition, combined with rising protectionist policies, is fueling concerns about a potential global recession. According to an end-of-year 2024 report by the International Monetary Fund (IMF), the risk of a global economic downturn in 2025 stands at 30%, more than double the level recorded the previous year. In December 2024, the European Central Bank, ECB, announced it would continue to lower interest rates, following a drop in Eurozone inflation to 2.4%, the lowest level in nearly 2 years. As central banks tighten policies to manage risk, businesses may face greater difficulty accessing capital, which could hinder growth and employment. In the United States, the Federal Reserve has maintained a cautious policy stance, while consumers are increasingly tightening their spending. This reflects mounting pressure on everyday life, with persistently high prices for essentials such as food, energy, and loan interest rates for home and auto purchases. According to a survey by the Conference Board, U.S. consumer confidence dropped by 9 points in the fourth quarter of 2024, driven by concerns over prolonged inflation and rising living costs. In November 2024, former President Donald Trump announced that he would replace Federal Reserve Chairman Jerome Powell if re-elected, stating that Powell does not support his economic policies. This statement has raised concerns in financial markets about the potential loss of the Fed's independence, an essential factor in maintaining monetary stability. At present, the Fed has no stated plans to intervene should a market crisis occur, raising questions about its ability to respond effectively in times of major economic volatility. Since late 2024, foreign investors have begun withdrawing from U.S. government bonds. Meanwhile, gold prices have risen by 14% in just 3 months, signaling a growing trend toward risk aversion. For American households, this environment means higher mortgage and consumer loan interest rates, while a weakening U.S. dollar is driving up the cost of imported goods. If the Fed were to lose its independence, monetary policy could become more susceptible to political influence, directly impacting consumer spending, price stability, and employment opportunities. In just 48 hours after the U.S. chip ban, Intel lost nearly $100 billion in market capitalization. The U.S. semiconductor industry finds itself in an unprecedented vulnerable position, causing the prices of technology equipment and services in the U.S. to soar. How much will American consumers have to pay for this technological standoff? On April 12, 2025, the Chinese government officially issued a ban on the use of U.S.-made chips and software across all government agencies and state-owned enterprises. This includes major corporations like Intel, AMD, and Micron, with the goal of completely eliminating U.S. technology from the national infrastructure by 2027, ranging from telecommunication systems, energy, to servers. According to Reuters, this policy aims to ensure digital sovereignty and reduce dependence on foreign suppliers. The immediate impact: within 48 hours, Intel's stock dropped by 18.3%, and AMD lost more than 11% of its value. The total estimated loss for U.S. chipmakers could reach $350 billion by the end of 2027, according to Bloomberg. For Americans, this is a clear sign that the U.S. tech industry is losing market share in the world's most populous market, threatening thousands of jobs and slowing down domestic technological innovation. Intel, the largest chipmaker in the U.S., is now facing unprecedented pressure. In 2024, 27% of Intel's revenue and about $22 billion came from the Chinese market. Immediately after the ban, Intel cut 20% of its workforce in the departments producing chips for personal computers and data centers. The construction of a major chip factory in Ohio, which was expected to restore the U.S.'s leading position in the semiconductor industry, has now been delayed by nearly a year, with the new operational timeline set for the end of 2026. The prices of computers and laptops using Intel chips are projected to rise by 12 to 17% next year due to increased production costs. Cloud computing services and AI infrastructure will also become more expensive, directly impacting the operational costs of small businesses and individual users. Financial Times analysts suggest that this is a domino effect that could slow down the digitalization process in fields such as healthcare, education, and national security. Not stopping at the U.S. chip ban, China is expanding its strategy for technological self-reliance aggressively. Huawei has successfully manufactured 5nm chips without needing EUV equipment from ASML, marking a technical breakthrough for the country's semiconductor industry. Each year, the Chinese government invests over $58 billion into companies like Huawei and SMIC, providing support in finance, supply chains, and research. As a result, the share of chip imports from the U.S. has dropped from 41% in 2021 to just 28% by the end of 2024. According to data from the China Semiconductor Industry Association Reuters, U.S. companies are losing market share in one of the world's largest markets. Investment in chip manufacturing in the U.S. is at risk of stagnating, leading to job losses in the high-tech sector. The cost of high-tech products in the U.S., from smartphones to AI computing systems, may continue to rise, contributing to the worsening inflation risk in consumer technology sectors. Car prices are rising, jobs are gradually disappearing, and Americans are struggling in the midst of a shifting economic landscape. What is happening to the auto industry, once the pride of the United States? Tariffs and protectionist trade policies have driven production costs sharply higher, pushing the price of American-made vehicles to record levels. According to Edmunds, by early 2025, the average price of a new car has surpassed $50,000 USD, while used vehicles are nearing $32,000 USD. With incomes failing to keep pace, many consumers are left with no choice but to hold on to older cars, even as maintenance costs continue to rise. Cox Automotive reports that a standard oil change, once around $50 USD, now exceeds $100 USD. Hourly wage earners and those on fixed incomes are bearing the brunt of this burden, particularly as broader living costs, from groceries to gasoline, rise in tandem with the new wave of tariffs. McKinsey notes that 75% of American consumers have shifted to buying cheaper goods, primarily food, due to tightening household budgets. At the same time, unemployment is spreading. The manufacturing sector is seeing a jobless rate of 5.2%. Construction has shed 34,000 jobs. and agriculture has experienced a 3.8% reduction in its workforce. These losses stem from rising raw material costs, declining export demand, and widespread order cancellations, all of which are forcing families to cut back on spending, weakening purchasing power across the broader economy. As American car prices rise and deliveries slow due to parts shortages, Japanese and Korean automakers are gaining ground, thanks to competitive pricing and more agile supply chains. In 2024, Toyota captured 12.5% of the U.S. market. Hyundai Kia held 10.2%, and Honda accounted for 8.1%. These vehicles are known for their durability and fuel efficiency, qualities especially valued amid the steep increase in fuel prices, driven by new import tariffs. Hyundai has announced plans to invest $21 billion by 2028 to build electric vehicle and steel manufacturing facilities, expected to create an additional 100,000 jobs and stimulate regional economies. In contrast, many American automakers have been forced to scale back production due to rising costs, leading to widespread layoffs. This has reduced consumer access to domestic models, while further pushing up the price of American-made cars. The shift toward Japanese and Korean vehicles also reflects a broader trend, a trend toward more frugal consumer behavior. With U.S. economic growth projected to slow to 1.4% in 2025, down from 2.2% previously, according to McKinsey, many Americans are adjusting their spending habits in anticipation of leaner times. The 25% import tariff has driven up car prices by an average of 13.5%, or roughly $6,400 per new vehicle. This price spike not only strains consumers, but also directly affects manufacturing and exports. Ford has halted exports of the F-150, Mustang, and Bronco to China in response to retaliatory tariffs of 150%. Stellantis has laid off 900 workers across 5 plants, while Volvo has announced job cuts ranging from 550 to 800 positions. Current trade policies are weakening the U.S. auto industry, leading to declining revenues, job losses, and reduced access to domestic vehicles for American consumers. Without timely adjustments, U.S. market share for American-made cars could fall below 40% within the next 5 years. The inflationary pressure driven by tariffs is also spreading to other sectors. In agriculture, the unemployment rate surged to 12% in March 2025, the highest in years. This reflects the broader, cascading impacts on the overall economy and the daily lives of millions of Americans. U.S. imposes a 145% tariff on Chinese goods, shaking world's markets and revealing risky economic ambitions. The 145% tariff recently imposed by the United States on Chinese goods hasn't just rocked global markets, it's sparked big questions about Washington's new economic strategy. Is this truly just a tariff decision, or the opening move in a much larger economic showdown? It confirms total tariff rate on Chinese goods reaches 145%. The U.S. government has officially confirmed that the total tariff rate on certain imports from China has reached 145%, including a previously established 20% and a newly added 125%. According to a statement from the White House, this move is part of ongoing efforts to recalibrate the trade balance and address concerns surrounding industrial policy and economic security. Following the announcement, U.S. financial markets reacted noticeably. The Dow Jones Industrial Average fell by 3.4%. The S&P 500 declined by 4.2%, and the Nasdaq dropped 5%. These shifts reflect growing investor caution amid expectations of higher import costs, which could weigh on corporate earnings and dampen consumer outlook. Following a strong rally in early April, the U.S. stock market has experienced a downturn after news emerged that the U.S. government would impose a 145% import tariff on Chinese goods, specifically since April 2nd, when former President Donald Trump announced the tariff hike plan. The S&P 500 index has dropped approximately 6%, despite a session where it had gained over 9% shortly thereafter. In the trading session following the announcement of an additional 125% tariff, bringing the total tariff level to 145%, the Dow Jones Industrial Average fell by 1,700 points, around 4.14%. The Nasdaq declined by 5.75%, and the S&P 500 lost nearly 5%. Many experts believe that the high tariff levels have heightened concerns over import costs, directly impacting corporate profitability. Investor sentiment has also been affected by the lack of clarity surrounding trade policy direction, prompting more cautious behavior. The movement of capital away from equities towards safe haven assets, such as gold and bonds, highlights the increasingly defensive posture of the market. Bond market, according to former U.S. Treasury Secretary Janet Yellen, former President Donald Trump's decision to delay the imposition of tariffs on Chinese goods for 90 days reflects pressure from financial markets, particularly the U.S. government bond market. Following the announcement of the 145% tariff rate, the yield on 10-year U.S. Treasury bonds surpassed 4.4%, rising sharply from around 4.1% in early March. This surge in yields was largely driven by a wave of investor sell-offs, which caused a significant drop in bond prices, a signal of growing uncertainty surrounding traditional safe haven assets. This development is regarded as a warning sign for the U.S. administration, as a continued decline in bond prices could raise government borrowing costs and potentially impact the standing of the U.S. dollar in international markets. While the White House has stated that the temporary delay aligns with its original plan, many financial experts believe the market's strong reaction compelled the administration to postpone full implementation of the new tariff package in the short term in order to ease systemic pressure. Small and medium-sized enterprises. According to expert Yuan Zoe Liu of the Council on Foreign Relations, CFR, the United States' decision to impose a total tariff of 145% on Chinese goods may have far-reaching effects on small and medium-sized enterprises, a sector that accounts for approximately 80% of China's export value and between 70 to 80% of employment in its manufacturing industry. These SMEs primarily operate in low-margin sectors, such as electronics, textiles, auto parts, and household appliances, and rely heavily on access to the U.S. market. The high tariff rate undermines the price competitiveness of Chinese goods, leading to canceled orders and reduced export volumes. According to data from China's Customs Authority, exports to the U.S. in the first quarter of 2025 declined by 8.6% compared to the same period last year, though marking the steepest drop since the COVID-19 pandemic. According to Yuan Zoe Liu of the Council on Foreign Relations, CFR, the U.S. policy proposal known as the Mar-a-Lago Accord, named after former President Donald Trump's resort, could have concerning economic consequences if implemented. Under this framework, the United States seeks to simultaneously achieve three major objectives. 1. Systematically devalue the U.S. dollar in order to boost exports and enhance the competitiveness of American goods in global markets. 2. Maintain the U.S. dollar's global dominance as the primary reserve currency in the international financial system. 3. Transition the U.S. from a trade deficit to a trade surplus economy, while also calling on allies to contribute more to regional security costs. However, LIU notes that the aim of devaluing the dollar to support exports, while preserving a strong dollar to safeguard its global position, presents a fundamental policy contradiction. Historical experience from the 1985 Plaza Accord shows that currency realignment can create short-term advantages, but often leads to financial instability. Moreover, the U.S. has consistently run trade deficits since the 1970s. In 2024 alone, the trade deficit stood at approximately $773 billion, according to the U.S. Bureau of Economic Analysis, BEA, reflecting the persistent nature of the imbalance. Despite previous policy efforts, if the Mar-a-Lago Accord is implemented without coordination from major economies such as China, Japan, or the European Union, all of which hold significant amounts of U.S. Treasury bonds, confidence in the U.S. dollar could be weakened, potentially leading to instability across the global financial system.